and go over some problems. SE4. Tell whether the normal balance of each account in SE1 is a debit or a credit. SE1. Who wants to take accounts payable? What's the normal balance of accounts payable? A debit or a credit? The normal balance of a liability. SE1. Let me do this real quick. Here's the T account. This increases, that decreases. This increases, that decreases. Does this help?
Yeah.
This increases, that decreases. Okay? Got it? Okay. Accounts payable is what kind of account? Category? Liability. We always know the normal balance is the one that increases the account, right? So the accounts payable, a normal balance would be a credit. Because here's the debit side, here's the credit side. Here's the debit side, debit side, credit side, debit side, credit side. Guys, for a while, until it comes natural, have your cheat sheet, okay? So we'll go accounts payable, then you go, what kind of account is that? Oh, it's a liability. What's the normal balance? Well, I know the normal balance is the one that increases the account. It's a liability, so it's got to be the credit side. Make sense? So, let's talk about supplies. What is the normal balance of a supplies account? It's an asset, and it would be a normal debit balance, wouldn't it? How about withdrawals? This is trickier. What happens with a withdrawal? Withdrawals reduce owner's equity, don't they? So the actual withdrawal account is a debit because it does reduce owner's equity. Okay? What about fees earned? And what are fees earned? Revenues. And what do revenues do to owner's equity? Increase, so it's a credit. Perfect. What about supplies expense? Do expenses increase owner's equity or decrease owner's equity? Decreases. So a decrease to owner's equity would be a what? A debit. So expenses have a normal debit balance. What about unearned revenue? That is a liability. A credit. What about equipment? Debit. Guys, use this formula and just look at it whenever you answer a question. And then it will start coming natural. Okay, next. Is this helpful to go over these problems? Yeah. Okay, let's take this one. We're going to talk about these, okay? Because we're just starting into SE5. I'll make sure I have all these solutions online for you. Okay, let's go back here. Sean Michael started a computer programming business, Michael's Programming Service. For each transaction, indicate which account is debited and which account is credited. Now, guys, we're going to talk this through out loud, okay? The first transaction on May 2nd, Sean Michael invested $10,000. Okay, this is a transaction. Think about it. Sean Michael owns this company. He started it by investing $10,000. When did this happen? Recognition. When did this happen? May 2nd. How much? $10,000. What accounts? Classification. Cash is one side of it. Cash increased, didn't it? So cash got debited. So if we debit one side, what do we have to do on the other side? We need to credit something. Owner's equity increased also, didn't it? So as you go back here and see, debit cash, and we would credit S. Michael Capital, wouldn't we? Make sense? So cash got increased, and the Michael Capital equity, owner's equity, was increased, didn't it? Next, May 5th, purchased a computer for $5,000 in cash. Let's think of this transaction. We have a receipt that shows we purchased a computer for $5,000. So we know recognition, what day? May 5th. How much? Now we have classification. What are we going to debit? What's getting increased here? It is an asset. What kind of asset? Equipment? Equipment increased. Now, guys, an asset also decreased. Cash decreased. So do you see our equation stays the same? We had an increase in an asset, and we also had a decrease in an asset. We have a debit, and we have a credit. They just happen to both be assets.
So we debited the assets and credited the owner's equity?
No. We debited equipment because we increased equipment by buying a computer, but we used cash to pay for it. So cash is also an asset, but we reduced cash because we used up cash, so we had to credit the cash account, but we debited our equipment account.
So they zero out just under the assets.
Does that make sense?
So you'd have 5,000 and 5,000.
Exactly. Not on the same one. On assets.
On the same date.
On the same date, and we would show the T account for cash would get decreased, and the T account for equipment would get increased, but they're both assets, you're right. Okay? They're different accounts, but they're both assets. Is this making sense, guys?
Yeah, like the ending number in assets isn't going to change.
Ex-
It still equals liabilities
Exactly.
and the equation under assets.
Yes. This is, in my opinion, the toughest part of accounting is getting this concept. But you guys, if you get stuck tonight, go over these lectures again and again and again, and it'll be like, aha. Okay? Next. May 7th, purchase supplies on credit for $600. What are we doing? What goes up? Supplies. Supplies is an asset and it will go up. Now, guys, we didn't pay cash for this. We purchased them on credit. What does that mean? A liability. What happens to our liability? It increases. Now, guys, we have to debit something and we have to credit something, did we? We debited our supplies and we're crediting our liability, accounts payable, right? So we're debiting, we're crediting, and they both are going up. Make sense? Received cash for programming services performed, $1,000. We received cash.
Should that be an asset?
Yeah, and that would go up, wouldn't it? Now, we got that money because we performed a service. Service revenue, and that goes up. And what is the normal balance of a revenue account? Credit, because it increases our owner's equity. Does that make sense? Next, received cash for programming services to be performed, $1,200. Okay, guys, we haven't done the work yet. It's a liability. So what happens? We received money. Cash, what happens to cash? It's an asset and it's going up, which means you debit it. But what else are we going to do over here on the credit side? Credit liabilities, and that brings that up also. Unearned revenue. Okay? May 25th, paid the rent for May, $1,300. We've got to debit something, we've got to credit something. When we pay the rent, how do we pay rent? With what? Cash. What happens to cash? It goes down. So what are we going to do to cash? Credit it. So now we've got to debit something. Rent expense gets debited. Think about this. Expense accounts always have a debit balance, and expenses reduce our owner's equity, right? So if owner's equity has a normal credit balance and we're reducing owner's equity, we're going to debit it. Next, build a customer for programming services performed of $500. Accounts receivable. It's accounts payable is when we owe money. Accounts receivable is when we're going to get money. So we're going to debit accounts receivable. What else are we going to do? Credit service revenue, because we're receiving revenues. Is that making sense? Kinda?
I got a question.
Yes.
If it's accounts receivable and we're debiting it, is it our asset?
Yep. And it goes up. Think of it like this. Earlier, we performed services and we received cash of $1,200. When we receive cash, what happens? Cash goes up. We debit it. Accounts receivable is an asset. It's just we haven't gotten the cash yet. We're going to. So whatever we do, it's got to go up.
But then you said we have to credit service,
Revenue.
which is the revenue, and that would be in the owner's equity?
Yes. Correct. Okay? Next, let's go to SE6. And you see how you've got little T accounts already created for you here? Okay? So what we're going to do here, I want you to, I'm going to kind of put this open for you so you can see. Here, let me actually download this. How can I save a copy? Principles. Okay, I'm just going to open this up so you can see exactly how we're going to handle the SE6. SE6 wants us to create T accounts for the various transactions from SE5. So the first thing I want you to do, guys, the very first one over here, just write cash at the top. This first one. And then, as you can see here, the second, all I want you to do here is write the word cash. Don't do anything else. Then, all I want you to do is write accounts receivable on this next one. Then on the next one, I just want you to say supplies. Then on the next one, office equipment. Do you see how right there are all of our assets, all in a row? Then on the next one down here, accounts payable. And then over here, if I'm going too fast, you guys can know what I'm doing. Unearned programming service revenue, which is a liability. And then S. Michael capital. And then programming service revenue. And then rent expense. Now guys, we're going to do the same thing we did, but now we're going to, instead of saying it goes up, it goes down, it goes this, we're going to now post them to the T accounts, okay? So I'll wait till you guys are done, and I'm going to go get another drink. This time, hopefully it's a Diet Coke. You saw me, Fred.
Go one over to the left, don't pick that one on the right, because that's what we're doing now.
I'm screwing up, aren't I?
Well, it says Diet Coke, but I don't know why.
But you know what? I did it last week. I should have known better. Just like the 800 miles.
I don't
Instead
know
of
why
80.
anybody would drink diet stuff anyhow.
You know what? Guys, well, I'm is let's look at the problem. May 2nd, Sean Michael invested $10,000. What did we say we needed to do there, guys? Debit cash, and then what else? Credit equity. So guys, look what we're doing now. We're going to cash. Do you see that? And do you see on May 2nd how we show a 10,000? That's part of that transaction, isn't it? So we debited something. We now need a credit. Do you see we put over here May 2nd, S. Michael Capital? 10,000? Do you see how we have a debit and we have a credit? We're good, aren't we? Okay? That's all we did for that transaction. What? You can write these down now. What I wanted you to do is understand the transaction, and then we go write them down. Does that make sense, what I was trying to tell you?
Yeah.
So then that way, we take that transaction and we go, okay, on these accounts, we need to deal with cash. So we're going to do May 2nd. Remember, recognition, classification, and valuation. So May 2nd, 10,000 cash, debit. And then S. Michael Capital, May 2nd, a credit for 10,000. Okay? Do you guys have both that written down on your T accounts?
Yep.
Next. Now it says May 5th, purchased a computer for 5,000 in cash. What were we going to do there?
We're gonna,
Debit office equipment for 5,000. And then we're going to credit cash for 5,000. Do you see how we put that in there? Isn't this exciting?
riveting.
Debiting and crediting. Okay, riveting. Is that what you said? I know. My life is pretty boring, huh? Next, May 7th. Purchase supplies on credit for $600. What are we going to do? Debit supplies. And then what are we crediting? Accounts payable, May 7th, credit 600. Is that making sense, guys? So, Cecile, every transaction, we're going to debit something and we're going to credit something. Okay? Next, it says May 19th. We received cash for programming services performed, 1,000. What are we going to do? Debit cash on May 19th, 1,000. And then we're going to credit the programming service revenue, May 19th, for 1,000. See that? Next, it says May 22nd, received cash for programming services to be performed, 1,200. So what are we going to do here? Cash, debit, May 22nd. And then we're going to credit our liability, May 22nd, unearned programming service revenue, 1,200.
So it's clicking.
Is it clicking?
Bam, got it.
Okay, we're going to be patient and let Cecile go. Click. Cecile, you're going to text me, or you're going to get in the discussion and say, Nancy, it clicked.
I hope so.
Yes, it will. Next, it says paid the rent for May, $1,300. What happens? May 25th, we credit cash for $1,300. And then we go over to our rent expense. May 25th, we're debiting cash for $1,300. Or excuse me, we're debiting rent expense for $1,300. Then, billed a customer for programming services performed, $500. What are we going to do there? Debit accounts receivable, May 31st for $500. And we'll credit programming service revenue, May 31st for $500. Okay? Does that make sense? Okay.
And then all we gotta do is add them all.
Now that we completed this problem, now what I want to do is go back to the, let's go back to the PowerPoint and continue working on. We understand the increases and the decreases as we were talking about these various accounts. We know that our revenues and our expenses are part of an income statement, and we know the balance sheet shows the assets, the liabilities, and the owner's equity. Now, there's something in accounting called the accounting cycle. This is something we do over and over again. These are various steps we use to record these transactions and then create financial statements so we can present them to end users. So we start by analyzing these transactions like we're doing. Then we record the transactions in a general journal, kind of like what we're doing here, except we're using TAccounts. Then what we're doing is we're posting these transactions to the accounts. The next step is something called preparing a trial balance. We're going to prepare a trial balance, so we take each account and we show the debits and the credits, and we want to make sure they balance, the debits equal the credits. And then from that trial balance, we're going to need to do some adjustments. After we do some adjustments, we're going to create what we call an adjusted trial balance. And then from that adjusted trial balance, we're going to take the accounts that go into the income statement and put those in there. Then the accounts that go into the balance sheet and put those in there. Then once we prepare the financial statements, we're going to close out certain accounts. Certain accounts get closed out at the end of each period, such as the revenues and the expense accounts. And then after that, we're going to prepare something called a post-closing trial balance. So this accounting cycle is something we will do over and over again each period. We're going to always analyze transactions. We're going to record them. We're going to post them. We're going to prepare a trial balance. We're going to create some adjusting entries that we haven't talked about yet. Prepare an adjusted balance. Then we prepare financial statements and close out accounts. This happens over and over again. So let's talk about how this works. Remember, we have business activities. We're going to take these various activities, and based on these source documents we receive, source document meaning the invoice for the supplies we purchased, the receipt for the computer we purchased, the invoice for services we performed, and the check, the deposit. You see, those are source documents. We're going to analyze those transactions, and then we're going to record these transactions in something called a journal. After we record them, we're going to post those entries to a ledger. After we post them, we're going to create a trial balance. Then we might have to do some adjustments. Then we'll prepare financial statements. Those financial statements ultimately go to the decision maker up here. And then at the end of the period, we close out the accounts, prepare a post-closing balance to start again. This is the accounting cycle. Let's look at doing a little exercise here. You are given the following list of accounts with dollar amounts. Insert the account title at the top of the corresponding T account that follows and enter the dollar amount as a normal balance in the account. Then show that the accounting equation is in balance. So D. Logan withdrawals. We're going to put D. Logan withdrawals over here in this T account, D. Logan withdrawals, right? What is the normal balance of a withdrawal account? The normal balance of D. Logan capital is a credit because it increases owner's equity. D. Logan withdrawals, what happens to withdrawals? Does it decrease owner's equity? That's going to be a debit balance. So the first thing we're going to want to do is debit, we're going to want to debit D. Logan withdrawals. Now guys, what about accounts payable? That's a liability, isn't it? So what are we going to do with this liability if it's a normal balance? Credit it. Wage expense of $150. What is the normal balance of an expense account? Debit. What is the normal balance of a cash account? Debit. What is the normal balance of D. Logan capital? $400. Credit. And what is the normal balance of a revenue account? Credit. So here what we've done is we've put in our cash, we've put in our accounts payable, our D. Logan capital, our withdrawals, our fee revenues, and our wages expense. So again, our accounting equation, assets equal liabilities plus owner's equity. Our assets are $625, aren't they? They're going to be equal to our liabilities, which we only have one. How much is it? $200. Now our owner's equity consists of several accounts. They consist of capital, which we would add. Withdrawals we subtract, don't we? Because it reduces our equity. So we're down to $325. Fees revenues we add, right? $575. And then wage expenses we subtract. $420. So if we take the 400 minus 75 plus 250 minus 150, we have $425 in owner's equity. Do you see that the liabilities of 200 plus the owner's equity of 425 equal 625? And what are our assets? Assets equal liabilities plus owner's equity. Isn't that just amazing? So we're going to analyze these various transactions by source documents. We do not just create an entry into our accounting system because someone tells us, hey, I made this revenue. We have to have the documents to substantiate what we do. Okay? Source documents may be checks, they'll be invoices, receipts, or they could be contracts. But we have to have the source documents in order to enter anything into the system. Okay? A journal entry is a notation that records a single transaction in a chronological accounting record known as a journal. Each entry must be in proper journal form, as shown below. So if you look at page on your, how about SE8? Do you see SE8? It shows it's going to be a general journal. This is the proper classification where we show the date, and then we'll, under description, we'll show first of all the debit account name. Then we'll indent and show the credit account name, and the amount will show as a debit, and the credit amount will show as a credit. This is the way in which we'll record, or we call journalize, the various transactions. So let's do an example. On July 1st, Joan Blue invests $40,000 in cash to form Blue Design Studio. So let's just think about it. Joan Blue invests $40,000 into her business. What do you think the accounts are here? The classification? Cash is increasing. Owner's capital is increasing. So what we'll have to do is the journal entry to record an owner's investment, increase cash with a debit, increase owner's equity with a credit. It says here, if Joan Blue had invested assets other than cash, the debit would have been classified with whatever the appropriate account is. So instead of saying Joan put $40,000 cash in the business, what if Joan gave to the business equipment of $40,000? We would debit equipment, office equipment of $40,000, credit the equity capital account of $40,000. Do you see what I'm saying? But in this case, it's cash, so we're going to record it as cash. So, do you see here? We show the date. We show cash increased $40,000, and J Blue's capital account increased $40,000. Cash was a debit. J Blue Capital is a credit. The journal entry would be July 1st, debit cash, $40,000, credit J Blue Capital, $40,000. Does that make sense, guys? Do you see how the cash of $40,000 was journalized, but then when we posted it to the cash account, and the same is true with the J Blue Capital. Since the capital showed a credit of 40, we made sure and posted a credit of 40 to the capital account. Now, what about this one? On July 1st, Joan orders $5,200 of office supplies for Blue Design Studio. But we haven't gotten a bill yet, and we haven't received them yet. So when an economic event is not a business transaction, it doesn't get recognized. In this case, there's no confirmation the supplies have been shipped, that we've received them, or that title is passed. Just because we order something doesn't mean an economic event has happened. We haven't received an invoice, and we don't have the supplies. Make sense?
Okay, question.
Yes.
So, this is kind of like theoretical. If you wanted to show that you had the 40,000 cash, at the end of, let's say, May, and you were gonna go see somebody to get a loan, you'd have all this cash showing where you had already ordered something, but you haven't received it, and next month, or it could take 3 or 4 months, then it would show this minus this month.
Correct. Correct. So just because you order something doesn't necessarily mean it's an economic event. Now I'm going to switch it up on you. Let's talk real life, real world. Okay? If I order a computer, generally I'm not going to receive that computer. Sorry. You see, I have songs for my girls. My girl. That was my girl. Okay, sorry. Real world. We buy our computers from Dell. When we order a computer, I have to pay for it. Okay? They're not going to ship me a computer because I'm a little peon. They're not going to ship me a computer unless I've paid for it because they're specifying it to me. So what we're trying to do here is, in this situation, they're ordering supplies, but they haven't paid for them and they haven't received them. Okay? So nothing happens. When I really order supplies and I want, say, a computer, I have to pay for it up front before I even get it. Okay? So an economic transaction for me has happened because I've had to fork out the money. Technically, from Dell Computers' end, even though they received my money, until they ship me that computer, it's not a sale for them. Am I making sense?
Yes.
When we order Office Max, the reality is they charge my card before they ship it to us. But technically, they shouldn't record the sale unless the transfer exchange has happened. Does that make sense? So this is trying to help us understand when it's really an economic event. Does this happen in the real world? Not in my life. Just because I'm so small, they want the money up front. Now, I will go and print. We're printing stuff through Cornerstone Copy right now. We ordered all kinds of stuff, and we don't pay them until we go pick it up. So that does happen on a small level, but not with the Office Maxes or the Dell computers, because we're a peon. Okay? Any questions on that? Does that make sense? The U of M, on the other hand, different story. They can probably order 1,000 Dells, and they don't pay for them until
90 days after they receive.
Correct. Okay? That's how most businesses operate. Okay, now, even though they ordered the office supplies, there is not an economic event because nothing was recognized. They didn't receive the supplies, and there's nothing to pay until title passes. Now, on July 3rd, Joan rents an office for Blue Design Studio. She pays $3,200 for 2 months rent in advance. So what accounts are being affected here? Assets. We've got an increase in an account called prepaid rent. Okay? She paid for 2 months up front. So we're increasing an asset called prepaid rent, and we're also decreasing an asset, cash. So we're just switching our assets. A prepaid expense is classified as an asset because the expenditure will benefit future operations. This transaction does not affect the total of assets or liabilities and owner's equity. It just trades one asset for another. If the company had paid on July's rent, the owner's equity account rent expense would be recognized and debited because the total benefit of the expenditure would be used up in the current month. Okay? So as you see here, with paying 2 months up front, we have $3,200 of cash that was reduced from our cash account, but we increased our prepaid rent, which is an asset, by $3,200. Does that make sense? The journal entry would be a debit to prepaid rent for $3,200, a credit for cash of $3,200. Next, we have another transaction. On July 5th, Blue Design Studio receives the office supplies ordered on July 2nd and an invoice for $5,200. Now an economic event has occurred. We are going to increase our asset called office supplies. we're also going to increase our liability, accounts payable. So what we'll do here, our office supplies get debited $5,200. Our liability, which is accounts payable, gets credited $5,200. Does that make sense, guys? So here we debit our office supplies, we credit our accounts payable. Okay, so ultimately we're going to create all these different transactions, and then once we create all these various transactions, we then have we now have a listing of all the debits and all the credits in the various accounts. So do you see, once we do this, our assets, when we come up with our balance of cash, our balance of accounts receivable, office supplies, prepaid rent, and office equipment, our assets total $51,800. When we go to our accounts payable and our unearned design revenue, our balance and our liabilities is $76.80. Now if we go over and look at our owner's capital account, do you see how we have a credit of $40 in the blue capital? We have a debit of $2,800 in withdrawals. Then we take our $12,000 credit in revenues, and then our 2 expenses, and we have a net here of owner's equity balance of $44,120. Does our $51,800 equal the $76.80 plus $44,120? Yes. So from doing all those debits and credits, we're then going to create what we call a trial balance. Basically, all a trial balance is recording every single account and the correct either debit or credit balance, and then totaling these to make sure they balance. Okay? So that's what we're going to start doing now. We're going to go back to the book, and we are going to, on SE7, if you go to SE7, we are now going to create a trial balance. Do you see it says here, from the TAccounts created in SE6, we're going to prepare a trial balance. So basically, you're going to look at that worksheet I gave you. The most important thing you do is the title. You start by, at the top, putting in Michael's programming service. I'm going to open this door. It's getting hot in here. You guys are all starting to yawn. I'm not taking it personal. So I'm going to open up some air here. Ooh, it's colder out here. Woo. So, do you see how we start with the title? We show it's Michael's programming service. Then we have to say what kind of statement is this? This is a trial balance, and we show the date, May 31st. As you see, we just list them as you see them in the accounts. We start with cash, and we work our way down. You're going to see that the assets are the first to be recorded. So, logically speaking, if the assets are the first to be recorded, you should have primarily debit balances there, shouldn't you? Because assets have a normal debit balance. Then when you get to liabilities, you should have credit balances for liabilities. Okay? Guys, this is easy to make a mistake when you are transferring balances. Okay? So take your time and create this trial balance. And the key here is that your debits should equal your credits. Is this making sense, guys? So we show each one of those accounts that we had, the T accounts. Our cash ending balance was $5,900. Our accounts receivable ending balance was $500. Our supplies ending balance was $600. Our office equipment ending balance $5,000. All of those are debits because they're all assets. Our accounts payable is a balance of $600. It's a credit balance. It's a liability. Our unearned programming service revenue is a credit balance of $1,200. Our S. Michael Capital is a credit balance of $10,000. And then programming service revenue is a revenue account which has a credit balance of $1,500. And rent expense is an expense account with a debit balance of $1,300. The debits should equal your credits. Does that make sense? Can I move on from this? Are you guys okay with that? Okay, so as we look here, let's go back to the PowerPoint. And we have created a trial balance. We know the title is important. We list the accounts, and then we show the balances on either the debit or the credit columns. And we always list them in a certain order. Our assets are always first, then our liabilities, then our owner's capital, then withdrawals, then revenues, and finally expenses. So it shows that our debits equal our credits, but it doesn't mean everything's perfect. If the debits and credits in a trial balance are not equal, there's got to be a reason. Maybe we put a debit in as a credit or a credit as a debit. You know, so you try to find ways in which you can figure out what's wrong. A balance could have been screwed up. This is what's so beautiful about computer systems, because it's not going to happen. Or my most likely issue is from the accounts, I just put the number in wrong in my trial balance. So thank God for computerized. We're not going to have to deal with that. Now, in this scenario, and again, you guys may need to go back and review these lectures because we're covering so much. But in this scenario, they give us some accounts and we are supposed to create a trial balance. We've got to, if you were to just put the trial balance in this order, it would be wrong. You need to start with assets, cash, building, equipment, inventory, and land would go first. Then our liabilities, and accounts receivable. Then our liabilities are accounts payable. then our capital account. So you want to make sure you put them in that order, okay? And as you see here, our debits equal our credits. So, other transactions can be entered directly into the ledger. Identifying individual transactions or finding errors is difficult. Basically, we're going to go through now how we record the transactions and then post them. And we generally put these into a general journal. So the gist here is oftentimes companies have special journals to just show certain types of transactions. So at the end of the month, instead of putting each transaction in separate, they can total all the transactions and do one lump sum. But for simplistic purposes, we're just going to see how it really happens here. So we're going to create various accounts, and we already did a little bit of a general journal. And we're going to go through some problems and show how we record various transactions. Okay, so let's go back now. Does anyone need a break? Yes, no? How about we take a 5-minute break, guys? Okay?